All right, so here we are with purchase transaction for our perpetual inventory system. Now, immediately you're going to recognize this is much simpler accounting. And this is really the big challenge of this material, you'll note, is figuring out like whose shoes you're standing in, so to speak, because you're going to switch back and forth. Sometimes you're going to be in the shoes of the seller and have to do the seller accounting, and then other times you'll be in the shoes of the buyer and have to do the buyer accounting. Now again, this is just less information when you're the buyer, so that's why you'll notice the transactions are much simpler. Now, even though they're simpler, some companies like to employ what's called a supplemental system of record keeping, which just means they're just going to take these transactions and break everything down in terms of the following. In other words, what did they pay for the goods, your base cost there? Did they pay any taxes? Were there any tariffs that they had to pay for? Were there any purchase discounts taken, which is just a reduction in inventory costs, as you'll see in a moment? Did they have to pay for any transportation as well, which we'll talk about in a later slide here? So you can you can make this as complex or as simple as you want or need. It's up to you. So same basic transaction as we did for the selling material, except we're just going to look at it from the buyer's point of view. So you'll see a change in language. So now it's November 10th still. Burroughs Retail buys, so it's change in language instead of selling, obviously. $25,000 of merchandise on account from one of its valued vendors, so we switched language there too. Whoops. Which is now we're going to refer to them as a vendor instead of a customer. Customer is used for sellers. When you're the buyer, it's a vendor. So that's the relationship that Burroughs has to Vonnegut wholesalers. And of course, the terms are still 210 net 30. They're still going to return goods on the 15th, $5,000 worth, and pay the balance due on the 20th. So all that remains true. So the initial acquisition transaction is what? That's it. 2 lines done. Inventory, debit, accounts payable, credit. There's nothing more to account for. They simply just don't have all that much information to worry about. So that's why it's so much easier for them as the buyer. All right, so what about the return? They return goods that they paid $5,000 for. So how would they book that? And the thing to keep in mind here is, again, there's no other accounts that we use in a perpetual system. There's no such thing as a purchase account. Popular misconception in this material is people think that we're using purchase. It's like you will not see a purchase account used anywhere. I only bring it up in the context of the periodic system, just for contrast, but you will never see it in the system. So when they return goods, all they do is just what? Just basically it's a partial flip-flop of the debits and credits that they did, in the previous transaction. Now they debit accounts payable and credit inventory $5,000. So just again, to contrast that with what we did in the selling function here. So the selling, we had to do all this stuff here because they had to worry about, again, so this is really, that's the corollary for what the seller did, is this piece here, right? Just those 2 lines there. Like what's happening down here was just a function of because it was a return, right? So in reality, if you look at these 2 lines here, right, you just look at that, and I asked you, is this a return or an allowance? You would be like, I don't know. I can't tell because there's no way to tell the difference. You'd have to look at the details of the transaction to know if it was a return or an allowance, because as far as the accounting is concerned, it's identical. It's just take $5,000 out of AP, take $5,000 out of inventory. So there's no way to discriminate it. All right, now, remember we talked about memoranda here. We talked about that credit memo. So just to revisit that, so again, the seller's going to say, hey, we're crediting your AR $5,000, and what's the buyer going to do? Hey, we're debiting our AP with you $5,000. So of course that's going to be a debit memo. And why do we want to issue this memorandum? It's very simple, so that both companies involved in the transaction, buyer and seller, both agree that the value of the return is a specific amount. They both agree in this case that it's $5,000 because they have to. Because remember, whatever your AR is, the other company's AP, those have to balance against one another. They must be identical. They can't be different balances, right? So that's because of that reality that they can't be a different balance. You've got to make sure that you reconcile with each other. So again, why might that not balance? Why might you have an inequality there? Because one party doesn't agree to what the value of the return is. Right? This is why invoicing practices are very important in your business. If you're going to deal in tangible goods, make sure that people know line by line what they're paying for the goods. Your customers understand that. If they go to return something, they'll know that this is how much they're going to get back. Not going to get any more or less than that. So usually this type of confusion happens in bulk purchases where like somebody negotiates to buy a bunch of stuff at once and it just kind of gets thrown together, and in the invoice it gets thrown together, lackadaisically. It just says, here's a bunch of stuff. What if they return some of it? What's your formula for figuring out what the value of the return is? That can be pretty crazy. And maybe there's really no sound way to determine that, ferret that number out. That's why I want to make sure line everything up so that your customer understands the value of the return. But if, let's say, you do have a problem, now you can say, wait a minute, we don't agree, and then you can iron out that difficulty because maybe again, you don't want to sour the business relationship. So that's what the memorandum will serve as. Confirmation, you both agree to the value of the return, and if you don't, you can begin the process of figuring out what is the amount that you agree on here. All right, so what about them paying within the discount period? Again, just for contrast, what did it look like when it was the seller? So the seller had, so you'll notice everything that we used here is used here as well. It's just the opposite. So we have, instead of receiving $19,600 cash, we are paying. So that's why I have a cash credit there. And over here we had sales discount of $400. Now you'll notice what? That is going to be a purchase discount, but guess what account we use? Inventory. Same as we used for the purchase return in this case. Everything flows through inventory. The initial acquisition, the return of goods, and the discount on those goods. Everything goes to the inventory account. No special accounts used. And of course, whatever our AP balance here, 20 was the AR balance that our vendor had on their books. So all that matches up. So same three numbers, just used differently. Now here's the general rule to follow when you're dealing with purchases. And that is, this is the parity you want. In other words, whatever you ultimately paid for the goods, this number right here, should equal the change in inventory. So what do we see? Inventory initially went up by $25,000 minus $5,000. So that was $20,000 minus the $400 for the purchase discount equals $19,600. That's what we paid for it. So in other words, the increase in inventory also matched the amount of cash that we ultimately paid for the goods. Why do we want those to match? Because a lot of businesses look at their inventory in terms of unit costs, not just this lump sum. What are they paying for each unit of what they acquired? Therefore, you want to keep the integrity of those numbers intact so that you can figure out, so that $19,600 they paid for the inventory, now they're going to say, okay, what is our computational amount for what are we paying per unit? What's important of that? And again, the importance of unit cost is more apparent when we look at the next chapter, when we switch from 5 to 6. So when you see in 6, everything is phrased in terms of units, you'll be like, oh, okay, I can see why that matters now, because that's where it's really going to come into play. And again, other concerns are, if you don't understand what you're paying for each unit, maybe you don't understand what you should be charging for each unit. That's a problem, right? And certainly, it's gonna definitely muddy what your margin per unit is. In other words, that concept would simply be like, okay, you charge $10 for something and you paid $5 for it, so your margin is $5 a unit. Well, if that unit cost is being somehow muddied because of your accounting practices, that's not correct. So again, some of those concepts that you'll see what I'm talking about, you see in 102, it would interfere with your interpretation of the data there. So that's why you want to make sure you, again, maintain the integrity of what you paid ultimately for the inventory, so that ultimately what you paid equals what the change in the inventory account was. That rule should always be followed. All right, so we'll skip a couple of slides here. Again, that was the initial sale there. All right, so again, what if Burroughs doesn't pay until the 10th? Well, then this is just for contrast. So it's just going to be your basic payments on account. Accounts payable debit, cash credit for $20,000. All right, so the last little bit of this video that I'm going to cover is going to be the basics of shipping terms, and then we'll look at specific examples of shipping terms in the next video. All right, so shipping terms, again, because what's going to happen is most of the time you're not going to be buying or selling goods face-to-face. Stuff's going to be shipped. So the big question, of course, is who's paying for this, right? It's common sense right there. So your possibilities are just really two. It's either going to be the buyer's paying or the seller's paying. There's nobody else involved here. So your two terms of sale are right there. So we have FOB, they both start with that, which means simply free on board. I'm going to add some other words that are not obvious with respect to either the shipping point or with respect to the destination. So when you see shipping point, I want you to think, where do the goods start? Where do they start? They start at wherever the seller's place of business is. So in other words, if they're free on board with respect to the shipping point, that means they're free to the seller, which means the seller is going to pass the cost on to the buyer who pays. And they're going to add it to the book's cost, in this case the buyer I'm referring to, of the merchandise purchased. And again, this would be true of any asset acquisition. The rule is if you acquire assets, all necessary costs of acquiring the asset should be included in it. So again, that would be, as I talked about in the first slide right here. So in other words, if you acquire goods, and you're again talking about that supplemental system here, everything is going to be included in there. And again, I noted transportation costs, right? So that's one of the ones. And again, other ones I mentioned were taxes and tariffs, possibly again subtraction for a purchase discount taken, such as what I described there. So again, all of those are relevant to the cost of your goods. So again, I usually go with an example of, just to underscore this, like let's say you buy a new computer on Amazon for $400 and they charged you, in this case, you get charged shipping. Doesn't follow through Prime, just to make that completely legitimate, as an example goes. So let's say you had to pay $20 for shipping. So what did you pay for the computer? $400 or $420? Well, what did they charge you? Like if you look at the piece of paper that comes with it, the invoice, and they say final amount charged was $420, well, everyone's going to say, well, I paid $420 for it. Exactly. In other words, the cost of the computer to you was $400 plus the $20 for shipping equals $420. So that's why, again, if you're the buyer of something and you paid for shipping, you add that cost to the asset value because it's part of the acquisition cost. It's simple as that. All right, so that's, again, the first one, FOB shipping point. And if we switch to FOB destination, now we're saying it's free to where the goods are going because that's where the buyer is. So now the seller is going to absorb the cost here, and they're going to book delivery expense because the buyer's paying nothing. So let's look at how these two terms affect the two parties to this transaction, buyer and seller. So first we'll focus on FOB shipping point. All right, so the buyer, of course, obviously is going to pay for the shipping. The buyer has something called an insurable interest in the goods. Right, so what does that mean? We'll get to that in a moment. And again, they're going to record that as a debit to merchandise inventory, or just simply inventory. Merchandise inventory is the old-timey way of referring to that rather than just inventory, but I still keep it in my handouts once in a while. You'll see it there. All right, so they'll add that cost. All right, so if you're the seller, it's no cost to you. And again, here's the important point. Number two, goods are no longer owned once given to the shipping company. So that's the big question. Who owns the goods in transit then? Now, a lot of times when I posit this to a class in person, obviously don't have that luxury at the moment. Like who owns the goods in transit? It's a common misnomer, misnomer that people think, oh, well, the shipping company owns it. It's like, no, shipping companies own nothing. Shipping companies are merely just, the custodians of whatever is shipped through them. That's it. They have what's called a fiduciary duty of due care. That's all they have there. That was, they should take care of it. Unlike the opening sequence of Ace Ventura: Pet Detective. Feel free to look that up at your leisure. You'll see what I mean, as there is a package being exceptionally abused at the opening sequence of that film. That would be definitely a breach of that fiduciary duty, is what I'm talking about there. So, who owns it in transit? Well, here's the rule. Because the buyer paid for the shipping, the second the seller relinquished ownership of the goods, in other words, physical ownership, they said here, they gave it to the shipper, the Federal Express person, the UPS person, whoever, the post office person who collects it. The moment they handed it over to that shipping company, they stopped owning it. The buyer now owns it. That's why I said the buyer has an insurable interest. That means they have the right to indemnify themselves against a loss in transit. So in other words, if the goods are shipped, and then again they're shipped via cargo plane, and something happens to the plane in transit, it's a non-violent example here. The pilot and everyone else bailed out. perhaps landed on an island, ended up talking to a piece of sporting equipment, whatever. All that was lost was just stuff. So as the buyer, if you did not insure yourself in transit, you actually still would have to legally pay for the goods because they were lost and you had the right to indemnify yourself. You chose not to exercise that right. The loss falls to you. The seller didn't own anything, you owned it. So that's the idea here about insurable interest. Now, obviously, in practical terms of like, when should you insure something? Like most goods nowadays, I believe it's just automatically $100 is what they're insured for. You don't even have to take out any kind of supplemental insurance for that. It's just $100 flat. If it's expensive, insure it. If you're paying for the shipping costs, if they charge you for the shipping, which is obviously what's happening here, ask, does that include insurance? If not, what will that cost? Because I know if it gets lost in transit, I will still be responsible for paying for it even though I didn't receive it. And don't always automatically assume because you paid X for shipping, it includes insurance. Ask for this. Now, obviously, if it's something cheap, like a $20 item, again, on Amazon or whatever, it's like, the way they work is something gets lost for $20 and you say, what if I get it? And they refund your money. You go, well, just keep it. They don't even care. So in that case, obviously, if you had to pay for shipping on it, you would probably just say, well, it's not worth it. And again, it's probably covered anyways. So it should really be reserved for costly items. That's the idea here. Now, the last part of the seller here is, number 3, is the seller might pay on behalf of the buyer and charge the cost to accounts receivable. So what I'm talking about here is, in other words, which party is in a superior position to determine what the cost of the shipping is. And obviously it's the seller. They have the goods in their hands. They know how big it is, how much it weighs, and all that. So because of that, this is how you'll see it structured when we do the transactions in the next video, is that they'll add the cost of the shipping to the accounts receivable of the customer. So that'll just be embedded in the accounts receivable. And you see how that works in, again, the next video. All right, so let's switch to FOB destination. Right, so now we have no cost to the buyer, obviously. And again, now they don't owe the goods until delivered. In other words, because the seller is paying, now the seller has the insurable interest. So everything I said in the previous example applies here, but now to the seller. So they give the goods to the FedEx, UPS, USPS person. And at that moment, because they're picking up the cost of the shipping, the seller is, they still own it all the way in transit until it's actually physically delivered to the buyer. So in other words, until they take physical possession, buyer doesn't own anything. So now if we have the same example where this cargo plane goes down, everything's lost. If the seller did not insure themselves in transit, they lose. They cannot charge the buyer a dime because the buyer didn't pay. How are they going to handle this cost of having to, absorb the cost of the shipping? They're going to directly debit this to delivery expense or transportation out because it's a periodic expense. Just for contrast, like what happens to the cost over here? In other words, when you have to debit it to inventory when you're the buyer and you pick up under FOB shipping point, when does that become an expense? Not until you sell the merchandise, and then it becomes part of cost of goods sold. So eventually it becomes an expense, but it takes time. It takes time until you actually sell the goods before you will observe that. All right, so the general rule that we're going to observe here when we get switched to the transactions is shipping costs, again, if they're added to the buyer's accounts receivable, are excluded from discounts. So you're going to exclude that from the discount. Discounts are only applied to goods purchased by the customer, less any returns and allowances. So again, that's the rule that we're going to abide in the next video. So you'll see this slide again, because I might refer back to it on the next video. So bye for now.